Hey dividend investors, today I'm going to talk to you about a interesting ETF, if you should buy it or if you should not buy it and just buy the individual stocks inside of this ETF. This ETF is the BMO Equal Weight Banks ETF, short is ZEB on the Canadian stock market. Let's get down, let's check it out, and see if we should just buy the individual banks themselves or invest in this ETF. Okay, so the average trading volume on this ETF is 790,000 shares on average per day. That is huge. For a Canadian ETF, that's actually massive. But what do we get? Well, we get an yield, at least a current yield of 3.85%. Is that good? Well, let's dive a little bit deeper. The expense ratio is 0.55%. And of course, it is currently trading at $33.26 per share. And as we can see, this ETF has done pretty well the same as the actual Canadian banks as it holds, as it should. In reality, it should just really mirror the banks. And as we can see, the banks have not had a great time from 2018 to about 2020. They've been pretty well sitting in what I would like to call a rut, and that is essentially what this ETF has been showing. It has climbed from $22 per share up to $30 per share. It absolutely went hugely down during the coronavirus, which the banks did as well, but it has nicely recovered as well. So on the surface, it doesn't seem like it's all that bad of an ETF, and it really isn't. The real big issue with this ETF is that MER of 0.55%. And now, when you look at the top 6 holdings, which equals 99.73% of all of the assets in this ETF, you see that it's Bank of Nova Scotia, Bank of Montreal, TD, Royal Bank, CIBC, and National Bank. Just like it should be. That's the top 6 banks. That's the big 6, they call it in Canada. But what do we see? Bank of Nova Scotia, 18.5%. BMO, almost 18%. Then we have TD at almost 17%, and then we have Royal Bank at 16%, and then CIBC at 15.75%, and then we have National Bank at 14.6%. And as of late, and also over the last 5 years, National Bank of Canada has actually been outperforming the other 6 Canadian banks when it comes to their stock price. They were the only one that has actually increased its stock price and never really plateaued. The other 5 banks have. So in my opinion, I would be personally holding National Bank at a higher rate, or at least a higher percentage, if I wanted the ETF to grow faster. However, how they are currently organizing this ETF is the bigger banks are up top and the smaller banks are in the middle, but it's hard to say that because Royal Bank is the third smallest holding. It's right in the middle, and it's literally the biggest company in Canada that's listed on the TSX as of today. So is this a good ETF? Let's really break it down. It's costing you 0.55%. Which means that for every $100 that you put into this ETF, every single year it's costing you 55 cents for them to manage your money. And every single time you add a zero onto that cost of what you buy in at adds essentially a 5 to the equation. So if you put $1,000, it's $5.55. If you put $10,000, it's costing you $55.55 per year. And then if you go to $100,000, it's costing you $555.55, which means that now this is adding up. If you're only putting $100 into it, sure, but at the same time, could you save that 55 cents by just buying one of those banks? Because they all pretty well move in lockstep mostly. Mostly, not necessarily. As I was mentioning, National Bank of Canada has been outperforming. They are absolutely outperforming the rest of them. However, because of that, their dividend is lower than the rest of them. At the same time, we have Royal Bank, who is the biggest company listed on the TSX, and at the same time, Royal Bank is also the biggest company or biggest bank in Canada. So could you invest in them? Yeah, you totally could. At the same time, however, could you also find one of these 6 banks that has the lowest PE ratio to highest dividend and then buy that one? Because that's actually a fantastic strategy on how to buy the banks, and I've actually made a video on that concept. So, is this a great way to buy the banks? Personally, considering that it's only really holding 6 companies, you could literally buy those 6 companies and not pay BMO 0.5% every single year. That adds up over time. Now, sure, we talked about $100,000 and it's costing you $555. That's at the maximum end of everything. But at the same time, could you not just buy those big 6 banks and collect the dividends? Find the ones that pay the higher dividends and have the lower PE, because usually what happens with the Canadian banks is the lowest PE ratio means that that bank is not currently favored by investors. So you buy that one, just like the Warren Buffett idea is to buy the stocks that everyone's running away from. Because it's a big 6 bank, they've all paid a dividend for over 100 years. They've never cut, and they've also never lowered. So what I'm saying here is to buy the Canadian banks that have the lowest PE at this time, that have the highest dividend, which just so happens to be BMO and I think CIBC, if I remember correctly, and National Bank just because they have the highest growth. Canadian banks right now are the new growth stocks, so we have to keep that in mind as well. So anyways, I hope that this video has helped. Personally, I would say not to buy this ETF and to just buy the Canadian banks. I'll see you guys in my next video.